Okay. All right,
Yeah,
cool. Okay, so we're good to go whenever you are. Thank you so much, Tom.
cool. No problem at all. No problem at all. Yeah, so I'm Tom from some Matthew Douglas Limited. So I'll give you a little background on who I am, I suppose, first and why I'm here. So I've been working with Well Financial and now obviously this charity as well. And I'm just basically here to hopefully give you a bit of an overview as to sort of what your options are to help you do better with your existing funds or to how to generate more wealth for yourself and to sort of set yourself up better for life, really. So hopefully I can cover a lot of that in this session. And yeah, so myself, I used to be a maths teacher. So I probably over 4 years ago now, I was a maths teacher. So hopefully, if you learned something, that was hopefully due to the training I had for that. But yeah, actually, this job's quite similar to that. To be honest, we're sort of trying to educate people about finances. So it's more like a tutoring sort of rather than a teacher, I suppose. But it's yeah, I find a lot of similarities over it. But yeah, I just want to sort of probably touch on what we're going to talk about then. So I've got an agenda here. So we're going to talk about who we are, Matthew Douglas Limited. So just briefly, just whilst I'm on that point, we are a Suffolk-based financial advice firm and a family business, and I'll give you a bit more information on that in a second. But whilst I go through those, so saving and investing, I think that's important to a lot of people. I think that was one of a lot of the questions came in about that. ISAs and LISAs, again, links to saving and investing. And we've got some of the other savings tools that probably the ones that probably we use less actually, but everyone who's probably watching this use more already. Then you've got pensions. That's really at Matthew Douglas. That's a lot of our bread and butter is pensions. A lot of people we speak to have workplace pensions they want advice on, or they want to set up something. So we'll touch on that. The wealth if you plan. So again, it links to all of the other points really, to be honest. And then what you can do to get started. I'm also going to touch a little bit on student loans as well, which isn't actually written in there, silly. But then we've got any questions, which I think we're going to go through at the end as well. Right. So who we are. So as I said already, family business. So my dad started the company about 25 years ago now, and we've been fortunately going from strength to strength. I've only been here for probably 4 or 5 years now, and I can't take all the credit, but since I came in, we've won quite a few awards, fortunately. So and we hadn't won any before that, so I'm trying not to take the credit, but so Family Business of the Year awards 2025. I think we also won in 2024 as well, and Best IFA in the East of England in 2024 as well as a few other things. So hopefully we've got a good track record to give you some confidence that hopefully I know a little bit about what I'm talking about, but you'll see as things go on, I suppose. Right, so bring it all together. So these are the little bits that we do basically. So financial planning, I think that's very broad, really. That's just as it says on the thing, financial health, setting goals, developing a plan. That's sort of when you see a financial advisor, that's what they're gonna cover. But the stuff that we do, so we do investment advice, retirement planning, tax planning. We're not accountants, but we have to have good knowledge on tax, as you'd expect. So anything I advise on, I can speak to accountants to get sort of a second opinion, and we have to have good knowledge on that. Insurance advice, we do insurance. Financial advisors generally would do insurance. Debt management, we can help you with that, and sometimes you have debt advisors. We actually do have two members of the team who used to be debt advisors. So we have sort of specialists that are in that field. And then we've got educational planning. So it could be building up a plan to save for something, which may be relevant to some people here, as well. And legal planning, we obviously don't do that because we're financial advisors rather than solicitors, but we have a close relationship with a lot of solicitors. So we have good knowledge on that too. And yeah, we can always bring in support if we need to from another solicitor. Estate planning, that sort of planning for your inheritance tax problems if you were to have any. So if your estate is too large and there are ways you can reduce that, that's something we can do as well. Not something I'm going to touch on that much today because I don't think that was an immediate thing I was asked to speak about. But if that's a question that I get, then I'm happy to talk on it. And then every client that we have that comes through the door that signs up as a client, we have an ongoing relationship with that person. So we at least will speak to everyone once a year in a proper face-to-face meeting just to get an update on how everything's going financially or or even other things. So it could be something in the family that's happened, and then they talk it through with us that could affect their finances, or that they're something they're worried about. So that's, I suppose, an overview as to the kind of stuff that we talk about on a daily basis. So yeah, next one. So just an overview of where we fit in on this little chart. So we're in the investments bit and the protection bit mostly. I mean, I know some people watching this may already dip their toes into investing in crypto or anything, or AI and technology and stuff like that. We don't do crypto investing here because it's not as well regulated as the things that we do. And also, to be honest, our knowledge is not as great on that stuff as the normal pensions, ISAs, and other products that we invest through. Yeah, the other stuff that's all taken care of through. I know all of you will likely have a bank account, and yeah, so we keep our ears to the ground on this kind of stuff, but it's not the stuff that we mostly do. Will be investing for people and protection, stuff like that. Right, saving versus investing. So I suppose there could be a misconception on this, that if you're saving in a cash ISA that you're investing, and we wouldn't necessarily classify it that way. So if you're investing, in inverted commas, in a cash ISA, you're sort of getting whatever the rate is that that bank is willing to give you. That bank is willing to give you that rate because they know that they can invest it themselves properly to get a better return, basically. So that if they say, oh, we're going to give you 4%, they're hopefully going to get 6% on that money. So they're going to make that 2% difference. So you could sort of cut out the middleman if you really wanted to and actually invest it yourself. And that would be through a stocks and shares ISA or another product that you can invest in. So I suppose that's something that people might not have considered. But compound interest. So if you're investing, or if you're just saving at a certain rate, obviously that money grows, and each year the money, along with the growth that you've had, will grow further and compound that growth over time. So you should see, whenever you invest, it should be like an upward sloping curve, which should hopefully it's upward sloping. That's an indication that it's going in the right direction anyway. Yeah, and then you've got investment returns. Generally, if you're investing money properly, it could even just be very passive. It could be just following an index like the FTSE 100 or the S&P 500, which is the US version of that. Even if you're investing in those things, you're going to get a better return generally over the long term than a typical sort of cash ISA or cash product. Just because you have got a bit of market risk involved in that. You can also invest in bonds. Again, there's risk with bonds too, but there's much less risk in cash. But there is a slight caveat to that, in that depending on the rate of inflation and the rate that you've got in that cash. If you have a cash product which is generating you X%, but inflation is actually X plus 1, all we know is for 100% you're losing money on a real rate, because if it's X plus 1, you're 1% less than what inflation is. So yeah, you should, at that point, you don't want to be in a cash product if inflation is actually ahead of that point. You want to be invested into something that's going to be ahead of inflation. So at the moment, I mean, we typically use on models about 3% as like an inflation sort of benchmark. I mean, at the moment it's a bit higher than that, I believe. But yeah, that's typically how we see, sort of how we model it, just to give ourselves sort of an average. We typically say 3%. So in addition to that, we would use 4% for a savings interest rate if we were doing a model, and we'd probably use 7% for an investment return. 7% may sound quite punchy, but actually that's, for a medium risk investor, that's what we've achieved for the last 15, in fact, since 2006, I think. That's what the average return would have been. They would have had 7% if they just went a medium risk, nothing too fancy. They should have achieved around that. So that's completely realistic. And then inflation 3%. Again, that's higher now than it probably was 5 years ago. It was probably around 1% at that point. So yeah, it's changed the models a little bit over the last 5 years for sure. And interest rates are much higher than they used to be as well. They were sort of in the 0 point something. So yeah, a big change there. I've got a few models actually, which hopefully will sort of give you an illustration as to what I'm really talking about. Um, as I've already said, actually, just before I move on, I should cover that bottom point. That investments do carry risk. I think I have mentioned that already, but just so everyone's clear, because the graph that comes up in a second is a smooth curve. That isn't realistic. So I'm going to come back to that. Just so there we go. That's the smooth curve I'm talking about. That should be wobbly, but I'm just giving you an illustration. Right. Saving and investing. So we've got investments column. There we go. So we've got the nominal savings and nominal investments. So that's the fourth and fifth columns. They're sort of what you'd do is a comparison of if you invested £10,000 at the end of year one and it grew by 4%. In that nominal savings column, you'll see it should have grown by £400 if it's grown by 4%. If it's grown by 7%, which is the normal investments one, then it will grow by £700 after that year one. You've got real savings further on from that, and the reason that's lower is because we've taken into account 3% inflation. So therefore, you should have eaten it by the end of that year. Inflation will have eaten into your money, but at a rate of 3%. So actually, you've made only 1% in total. And likewise with real investments, that's gone down 3% as well. So from £700 to just £400. So we've made a model to basically show you if you invest at the end of 10 years, what you'd get, end of 20 years, end of 30 years, etc. What you'd get if you were to save at 4%, assuming inflation was the same, 3% throughout. And again, assuming that 7% investment returns for that whole period. As I said before, you're not going to get 7% every year. This year, you probably got about 14% if you're invested in our medium risk portfolio. But then maybe a few years ago, when interest rates shot up, you would have got 0. So it evens out over the long term to get you that average of about 7. But anyway, so you've got, as you can see, by the end of year 40, nominal investments have grown to £2,136,096. But when you look at the real investments, if you look at actually how inflation's affected that, it's significantly lower. So in 40 years' time, that amount of money is actually only worth to us £729,000 in today's money, which is quite mind-boggling to think about that. But if inflation's just eating into everything. And yeah, the same for nominal savings as well. So it's £1 million in 40 years' time actually is going to be worth only £300,000 to us in today's money, just from the effect of inflation. But the other thing to note about that table is you can see that the numbers in the nominal investments table should be bigger than the ones in nominal savings over the long term. As I say, if it's a short-term investment, you can get a loss like pretty quickly, and then you would have been better off in a cash thing. But if you're saving for, or investing, should I say, for more than 3 years, it'd be better to have it in an investment, because the likelihood is if it goes down in any short-term period, it will have recovered quicker than, and to a point that's ahead of where you would have been if you're just saving it and getting an interest rate. That is the likelihood. I mean, I can't promise that will happen, but that's most likely what will have happened. So yeah, the graph basically explains that. So just gives you an illustrative, just gives you a picture as to what that would look like. So the contributions are literally going up by £10,000 a year, and this is what you would get if you did that. If you kept contributing £10,000 a year, which isn't anything extraordinary for a lot of people. £10,000, some people can contribute that amount every year. So you might want to do it on a monthly basis or a weekly basis. You can do that, but yeah, it just builds up gradually. And yeah, you can see how that would affect it if you just invested it or were to save it in a interest rate account with 4% or something. The next chart is basically, it's slightly confusing. So it's saying if you contributed £10,000, next year the £10,000 that you're going to contribute isn't actually £10,000 anymore. It's now £10,000 less 3%, because inflation's eaten away at it. So that's what those total contributions column, which is kind of like a strange way to look at it possibly, but the real savings sort of curves off. It because we've kept it at what today's £10,000 is. The contribution isn't maintained at the same rate, so therefore it curves down. However, the real investments also curve upwards. So hopefully that shows you that investing will still keep that upward curve, which is what we want to see. We want to see that exponential growth or close to it. It's called exponential, even though I'm a maths guy. I don't like the word exponential unless it actually is exponential. But I'm going to use that term anyway because it kind of describes what we're looking at. Anyway, next one. So how can you start doing this? So this is the actual interesting bit probably for a lot of you. So far I've been waffling a lot, but this is the stuff which actually is going to affect you. So things like ISAs that probably many people watching this have got an ISA, or a lot of a member of their family will have an ISA, I'm sure, whether that's a cash ISA or a stocks and shares ISA, or even a lifetime ISA, which are far less common. Yeah, the good thing about ISAs, which hopefully most people know, is that they are tax-free. So the money you've received from I don't know, the work that you do, that has been taxed for it to arrive in your bank account. But from that point, if you put it in an ISA, it will have tax-free investment growth, and it will have tax-free contributions and withdrawals. So you haven't got to worry about tax from an ISA perspective once the money's in there. So you can put £20,000 in a year. Hopefully they change that and they make it bigger in the future, because it's been stuck at that point for a little while now. But I mean, people may have heard that they're looking at reducing the cash ISA allowance in the future. So I think UK limit until 2027, and then they're reducing that. So on the face of it, that seems bad, saying it's going to be an £8,000 less you can contribute into a cash ISA. However, they haven't affected the stocks and shares ISAs. So you could still utilize your ISA allowance fully, but putting it into a stocks and shares ISA. I'm hoping that the government is thinking that they're trying to encourage people to put it into stocks and shares because they know that actually you're going to get better growth from it. I don't know if that's what their actual thoughts are, but I'm hoping that's what it would have been. But you can, as I say, put £20,000 still into a stock and shares ISA from 2027. So might as well try and use that if you can use that. So stocks and shares ISAs, I would recommend them mostly for people who have more of a long-term sort of plan for that money. If it's short-term, cash is still probably better in many ways, because you aren't taking investment risk. So anything sort of, as I've said before, anything beneath 3 years, probably a cash ISA is pretty safe. But then beyond that, if you're thinking slightly more long term, a stock and shares ISA is probably going to be a slightly more worthwhile investment. Just for that if we are getting 7%, as I said, that's an average. You're not going to guarantee that, but if you are getting that, that's going to give you a much better long-term prospects. So yeah, we've actually said 5+ years there. There we go. I've even I've contradicted myself slightly. So it says 5+ years, but yeah, if it was 3 or 4 or 5, it would apply either way. Lifetime ISAs, really, really good for first-time home buyers. However, they can also be used as a pension as well. So you can put up to £4,000 into them. That £4,000 does count as part of your ISA allowance. So you can't have £20,000 plus £4,000. It's £20,000 in total, of which £4,000 can be part a lifetime ISA. So £4,000, whatever you put into it, you get an extra 25% on top, which is obviously very helpful. Which so the max you can get is an extra of £1,000, being £5,000 in total. But if you were to put £100 in, you're still going to get an extra £25. So it doesn't matter how much you put in, you're still going to get 25% extra. You haven't got to max it out at £4,000 to get relief or to get the extra 25% bonus. But as I said, if you don't use it, you can use it for like a pension. So sorry, you can save it till age 60, and you can use it like you do a pension, and you can withdraw from it. The reason that I say you can use it like a pension is that you actually can have it earlier than that. You can have it at any point. The problem is you are actually penalised for using it before that point. So if you use it for a house purchase, you won't get penalised. That's what it's intended for. If you use it from age 60, you won't get penalised either. However, if you use it for any other reason or any time before 60, not for buying a house, you'll get charged 25% of the new value. which actually works out at a loss of about 6.25% or something like that. So if you put money in and then used it, you would actually have lost 6.25% pretty much straight away. So you have to make sure you are using it for the reason that it's for, otherwise it's not worth it. But it's a very good option if you are going to buy a house. What I would say though is be careful, and that's why maybe a financial advisor is probably worth speaking to if you're going to do it. The reason I say be careful is because you have to make sure that you're doing it in a legal way. What I mean by that is you have to pay it to a solicitor in order for you to get that relief and to retain that relief. If you just take the money out and say, oh, I've got this money to give to the solicitor, if you've taken it out, then you actually have lost 6.25%. So don't do that. Make sure your advisor or whoever's looking after that LISA pays it directly to the solicitor. Otherwise, the penalty will happen. Hopefully that makes sense. So yeah, you can start with £1, as it says on the thing there. I don't know if they would accept £1 on most platforms we look at. It's probably more like £25, but you know, you can get started on quite a low amount. So other savings tools. So I hope I've covered ISAs pretty well. If there's any question on that, I'll cover them. But you've got premium bonds. People do love premium bonds in the UK. And we see that so many clients we get say, oh, I'm investing in premium bonds. Unfortunately, we wouldn't describe it as that. We say premium bonds are not an investment, I wouldn't say. Similar to cash, they rarely beat your actual your inflation. I think the average prize fund size is roughly 4%. But that's kind of misleading because that's including the people who get hundreds of thousands of pounds and people who get millions of pounds. So the average person doesn't get 4%. They get much less than that because that's including the people. So it's probably more like 2.5 or something like that for the actual average person. If you were to exclude the big winnings, I mean. So yeah, what am I trying to say? We tend to advise that people use them as a really safe vehicle if you've kind of used up all your other options, rather than it being your first option, which is kind of the flip of what a lot of people come to us thinking. People think, oh, premium bonds are a really good place to invest their money. Invest in stocks and shares, I would say, if you want a long-term plan. If you want a short-term plan, or just something as a bit of fun because you like the idea of getting winnings, that's a good option. But people use their £50,000 allowance, they've got premium bonds, that could often be used better in a stocks and shares ISA, to be honest. If you've got that kind of money spare, if you're pretty much, it's not guaranteed obviously to get returns on a stocks and shares ISA, but as long as it's invested in a sensible manner, you're going to get generally a better return from a stocks and shares ISA than you are premium bonds. So we typically advise people to take some of that money out and put it into stocks and shares. In addition to that, if that is your scenario, then you're actually diversifying your forms of income or your forms of growth. So if you're putting all your eggs in, I want to get this win, what if it doesn't happen? So if you have some of that money you know is going to be generating some growth, then maybe that's a safer way to think about it. But as I say, they have a place, but we think of them as a savings vehicle rather than an investment vehicle. Fixed rate savings accounts, again, we don't really recommend these kind of things that much. It's sort of like people will pick the bank account they think is most suitable for them because it's dependent on your access requirements. So notice accounts, fixed rate savings accounts, as I say, they're suitable for you as your cash saving. So we don't really mind how people use their cash saving as long as they have a cash saving or an emergency fund, as we probably would refer to it. We typically say if you know what your expenditure is monthly, times that by 6, and that is what we would say you probably should have as your cash emergency fund. So 6 months, have that in cash. We don't really mind how you hold that cash, but just make sure you have it accessible in case something goes wrong, the car breaks down, the boiler goes, something like that. When I say goes, I don't mean someone steals it. Yeah, anyway. So again, we don't mind what way you do it as long as you have cash available to you. key considerations. So I've kind of already touched on a lot of these things. We've got safety versus growth. So we've got premium bonds and gilts. So we've got actually we're touching on gilts here. Okay, so we've got gilts. So that's government bond sort of investing. They tend to be quite low volatility, but they're pretty safe, and you can yeah. But again, we can use gilt ladders and different styles of investing like that to generate a more well. Typically, if you're getting a gilt thing, it's going to be ahead of inflation. But premium bonds, you're not guaranteed that. Actually, you don't know what you're going to get. Again, with your cash, you don't know what you're going to get, but it is very liquid. So things like premium bonds, you can get your hands on it pretty fast. If you have cash in a bank account, you can get your hands on that very fast. You can actually get your hands on stocks and shares money very fast as well, but people probably don't often realize that. It takes about, I probably should have touched on this earlier actually. It takes about a week for you to sell down your shares from your stocks and shares. So it doesn't take that long as long as you give an advisor, or if you're doing it yourself, as long as you have enough notice, you can have that money. The problem you have, I suppose, is whether you're selling at a good point in the market or not. So if the market has just dropped and then you sell, that's a bad time to have sold that money. But if you needed it, then that's all you could have done. But on the flip side, if something's just gone up and then you sell, that's really good. I mean, this year alone, I think a lot of our investments have made, I think that the average is about 5% already in the last 2 weeks. So it's just a very good time in the market right now to be taking your money out because it's at a very good point. But I'm sure at some point this year it will drop again. But I'm sure it will come back because the markets always have. But yeah, where was I going? Tax. Outside ISAs and pensions, interest above your pension savings allowance for basic rate is taxable. Yeah, that's true. So it's another consideration to make. Diversification. So I've already touched on this with premium bonds and how we use it as like a diversification tool. The important thing is just to make sure that you're spreading your risk across lots of different products and assets. And yeah, that should help you stay safer with your money. Here we go. Bottom line. I've not read this bit. Bottom line. For young savers, premium bonds offer fun and safety. Fixed rate accounts give predictable returns, and gilts provide stability. So I haven't touched on pensions yet, but I'm coming on to those. So have we got any questions on any of the stuff I've said so far that we can cover off?
Question, if you don't mind. With
Yeah.
the ISAs and other tools for
Mhm.
investing, is there an age limit to start from?
Good question. So junior ISAs exist, fortunately. So that means you can invest for your younger family members. So I believe it has to be a parent or guardian that actually has sort of the name on that account. So it can't be a grandmother unless they're the guardian. So you can, yeah, I believe you can contribute to it, but you have to have it set up through a parent, unfortunately. So for some people that makes it quite awkward, but it's just how it is. But you can start that process from any age. Same with a junior SIP, actually. You can do it from any age, but as soon as you turn 18, then it turns into a normal ISA again. And then I suppose that's a good thing to note is that if you are going to do that, if you're going to set up a junior ISA, be aware that that child is going to have access to that money when they're 18, and you have no control over that. So yeah, so if they want that money and they want it all out, and you're thinking, I want you to save that money for when you are buying a car or buying a house, they don't. That's their choice because it's theirs now. So yeah, bear that in mind. Which we have had some clients who've been hurt by that one. So,
Oh no.
was there any other questions on investments?
No, thank you. Been so
Cool. Okay, brilliant. If there is any at the end, I'll cover some. Where am I? Where's my mouse? There we go. So pensions, here we go. So this is a lot of what we this is generally mostly what we're talking about for with most of our clients. So workplace pension. So anybody who's got a long-term employment has probably seen a workplace pension before. However, they may not yet understand them because I know I didn't when I had on my first job. I didn't really get what my workplace pension was. I didn't know what it was trying to achieve. Other than that, I suppose it was trying to grow. So similar with ISAs and pensions. I mean, at Matthew Douglas, we have a portfolio of investments, and we would use that investment in a pension and or in an ISA. So the same strategy can be used for ISAs and pensions. With a workplace pension, it's not done by an independent advisor like us. It's done by, I don't know, if you might have a Royal London pension, or you might have, trying to think of another pension fund now. I don't know, the People's Pension Fund, whatever it is, or Nest pension. That has got, it has investments in it, but you can select the type of investment you want, but not many people understand what they are, or what they're likely to get at the end of their their tenure with that employer, like what they're entitled to. You can ask a financial advisor to check that you're in a fund that you're comfortable with. There are some that, for example, you might want an ethical fund, or a social and governance fund, or something like that, or it could be anything you like. There are specific investments that exclude certain things that maybe you're not comfortable with. But otherwise, you might just go into a general growth fund or a balanced fund, and it includes those are things that you don't like. So for some people, that is a consideration that they may not have thought about. But if you just come to an advisor, then we will go through what your options are. We'll have to write to the pension provider first and see what your options are. But once we know that, we can help you select one that's more appropriate. So not just appropriate on the E and S and G things that I've mentioned, but maybe relevant to your risk profile. So we'll do a questionnaire to work out what the level of risk is you're happy with. So you might be that actually you're really you want a lot of growth and you don't really care about the short-term losses, in which case you should be selecting a fund that actually reflects that. Likewise, you could be much lower risk. What I would say is, if you're younger and you've got a workplace pension, be aware that you can't touch that money until you're 57. So I personally wouldn't be thinking about short-term losses, because it's not a short-term thing. It's going to be until you're 57. So at least, well, maybe when you retire. So sometimes it's worth taking a bit more risk, even if your natural risk profile is a bit sort of lower. But you're thinking, actually, I'm not going to touch this till I'm 57, so I can afford to take a bit more risk, because in the long term, it will have made more money. I shouldn't say this, but I should. No, I'm not going to say. I'm not going to say it will. I guarantee it will make you more money, but I've never seen it not happen personally. So that's all I'm going to say on that specific point.
Can I come in here with a question?
Go for it.
We have a lot of young people who kind of like don't know if they should like contribute, or like, you know, just kind of write off a workplace pension as like, oh, I'm never going to see that, so it's not really worth it.
Yeah.
Is that valid? What do you say to that?
I would disagree with that wholeheartedly. I actually I like contributing to a pension. I know I'm not going to be able to touch it until I'm 57, but the truth is, you get relief on that money. So, and okay, there's a few points actually. I'm going to cover a few things. So your employer contributes to that pension as well as you. So if you're contributing, I don't know, 5%, I think it's the minimum requirement. So if you put 5% in of your salary goes into that pension, if you say yes to that, your employer will give you another 3% into your pension minimum as well. So often a lot of employers actually match what you're doing. So it might be that you do 5 and they do 5. If you work for a school or the NHS, it's often a lot more than that. It could be more than, maybe even more than 10%. So if you are committing to contributing to that pension, they will give you an extra 10% as well to match what you've done, if that is what they're agreeing to. So again, it's worth seeing what they're agreeing to and seeing how much you're entitled to. But the minimum they're going to give you is 3%. So it's 3% more than you would have had. So it's worth doing. I know you can't touch it straight away. You have to wait till you're 57. But if you can afford to not have that 5% that you are entitled to, you'll get an extra 3%. So that's, I suppose, a major consideration. But I suppose the extra bit on top of that is any money that goes into that pension doesn't pay, well, currently doesn't pay national insurance. I think they are going to try and get some more money out of us soon. But so yeah, at the moment you don't have national insurance on your pension contributions. So you're sort of avoiding having to pay that on that money if you're by contributing to it and on that 3% that you're going to get from your employer. So, but in addition to that, let's say you're a basic rate taxpayer, then if you were usually paying 20% tax when you receive income, the money that goes into your pension doesn't pay tax. It stays without tax. An even better thing about that is, let's say you're a 40% taxpayer, then you're getting 40% relief. So you're saving yourself 40% tax now, but when you retire, you might actually find you're not a 40% taxpayer anymore. You might be 20% taxpayer. So you've just saved yourself 20% because you saved that money for later, didn't pay tax on it now, and then only pay 20% when it came out of the pension, rather than paying 40% and withdrew it when you were a higher rate taxpayer. So if that is the situation that you find yourself in, it's definitely worth saving in a pension, because you're likely going to save yourself money, because most people when they retire most people, this is, so some people probably may differ, but most people don't need more than £50,000 annual income by themselves. So if there's a couple, that's £100,000 that you can have all on basic rate tax. So if you're saving at 40% and you're paying 20% when it comes out, that's a good deal. The other extra great thing about the pension is any pension you've got should have a 25% tax-free element to it as well. So the tax that you're actually saving yourself an extra little bit there too, because it's got a quarter of it is actually completely tax-free. So depending on the type of pension you've got, so if it's a workplace pension, they can be quite inflexible, which is quite frustrating. However, they're only inflexible whilst you're so in the sense that when you retire, if you try and take that money out, your options could be quite limited as to what you can do. However, you can always transfer it to another scheme that is more flexible. So you're not restricted in that respect. So if you're coming to the end of, so this probably isn't relevant to everyone that we're speaking in front of, but let's say you're coming to, I don't know, age 60, and you've got this workplace pension and it says, oh, I can only take an annuity, or I've got to take all of my tax-free cash at once, and then I can take a drawdown. They're my only two options I've got. Just transfer it to a SIP, which is basically the products that we manage, but other advisors would do this exactly the same. So it's called a self-invested personal pension. And if you transfer to one of those, you're completely flexible in what you can do. So you can take some of the tax-free cash now, some of it later. You can take the annuity if you want to. You can take it where you basically slice your pension into little pieces and so some of it's tax-free and some of it's not tax-free, just to make your income stay in the basic rate band. There's just a lot more options, basically. So if you find that you're getting restricted by your workplace pension, then when you get to retirement, it's worth speaking to an advisor to see if there's more you could do with that. And usually there is, to be honest. And often, a lot of the workplace pensions, you're very restricted on the investment choices you can have. So they're good to have, really, really good to have. It's better to have it than not have it. But let's say it is a Royal London pension, for example, you're only going to be given the choice of Royal London funds that you can invest in. If it's a SIP, so a self-invested personal pension, you have the whole market you could invest in. Literally any fund is available to you. So that's where someone like us could come in handy, I suppose, because we can talk with you about what the best strategy is. And it can be, it might not be a Royal London pension fund. It could be a completely different thing. But as I say, I don't want to talk people out of having workplace pensions. I want to talk them into it. They are worth having. They will grow like the investments, with 7% growth, hopefully, on an average basis. If that's just a median, by the way, if you were taking more risk, you could get 9 or 10, who knows? And you're getting free money from your employer. And there's 25% tax-free attached to it when you actually retire too. If you do come into a health problem, that means you cannot work. So this may be relevant. You can take the pension early. So it is possible for you. In fact, I spoke to someone, even, I think it was only 2 days ago. He actually had a heart condition himself. He worked at Felixstowe Docks, had a heart condition, can no longer work. But he's had an agreement that he can take his pension early. So he's not actually yet 57 or 55, whatever his pension scheme said, but he can still take his pension because it was agreed that he could not work. So, but because he had that pension set up, he can still take that money. If you don't have it, you can't have it. So might as well start. And then, yeah, was there any more questions on that? I've still got to go on the state pension, but any more questions on pensions like that? That's all right. State pension. So yeah, it's government backed. So I mean, well, I say government backed. It's backed by yourself too because you're paying into it, whether you choose to or not, almost. So you're paying national insurance contributions most likely, if when you're working, and even if you're self-employed, you'll have to do the same thing. It will just be in a different way. But yeah, you contribute on your through your national insurance. That pays for a income for life when you reach the national insurance age, which is 67 currently. Well, yeah, most people that I'm speaking to, at least, it's 67 anyway. It's probably going to be a lot higher than that when I retire, to be completely honest. But we'll see what it becomes. But it's at the moment it's about £12,000 a year for a normal state pension. So for a full state pension, that is. So as long as you've got, is it 35? Yeah, 35 qualifying years. So, i.e., you've worked for 35 years and been paying national insurance contributions during those 35 years, and you've maxed out the amount you need to qualify, then you can get the state pension. So at the moment, that's £12,000 a year, so roughly £1,000 a month, which is enough for most for a lot of people's I don't know, sort of the things they pay for all the time. So like the bills, and they probably won't have a mortgage by the time they're retired. So a lot of those bills will be covered by that £12,000, and really anything on top of that is just a bonus. At least for a lot of people that we speak to, that is how they feel. The other type of pensions that we haven't really touched on yet is some pensions you have aren't going to be as flexible as even the ones I've spoke about with the workplace pension. They may be ones like an NHS pension or like the teacher's pension, which is where you get a guaranteed income rather than a value behind it. And they're non-transferable, those specific ones, the NHS one and the teacher's pension. Other ones like it can be. So I've spoken to people who've worked for universities and they've got a USS pension. That one is transferable. So some of these pensions are, but it's very expensive to transfer them if you do, because they haven't got a guaranteed value behind them. They're just like a guaranteed income, if that makes sense. So some people may have that situation. You're still entitled to a tax-free element of it though. And for most people, taking the most amount of tax-free money is most suitable. I suppose the first point is it's tax-free, so that's probably a good thing. And the second point is, if you think about, if I were to take that money and ask to generate growth on that tax-free money, could I make up the gap between if I didn't take it and I get X income and I did take it and I get Y income? If you can make up the difference through growth on that money, then it's probably worth taking the tax-free money. But I'm not qualified to really give advice on that. So you can speak to a specific advisor who's got that qualification, because you do need specific things to talk about defined benefit pensions. Yeah, that's really on that slide. Were there any other, before I go forward, were there any other pension questions? Cool. Right, I've got a little bit here on student loans. I did a little lesson on this when I was a maths teacher, actually, strangely. And I think it was more because it was through COVID. I think we were trying to fill up the time somehow. I was actually teaching online, not like, I think a lot of teachers weren't. I think they're just setting work over the thing. But I was actually teaching online to my class. And I did a lesson on student loans. And I suppose the question is it worth it, really? So a lot of people are going to go into university, they're going to rack up a huge amount of debt, and they're going to come out of that their university and they're going to get a job, and hopefully they're going to earn loads of money, and then it will be worth it, so we think. So the problem is, I suppose, with student loans is that you have to pay it's a lot of money basically. It's a lot of money. It's a lot of money to go to university now, and to get the maintenance loan and the normal, just was it 9,000 and something now you pay to just be a student at a university now. And that does rack up. I think my wife's on like £80,000 debt or something. But I suppose you can think of it in a way as not really being a debt but being a tax. I don't know if that's, some people may have heard that before, but the way it comes out of your pay packet is much like your tax does. So it's just deducted from your pay packet. So it just means that you've got a higher rate of tax than someone who didn't go to university because you went to university. It does get wiped. I think it's is it 25 years or something something like that after you've been to university. I think it might be 30 years actually. But I should know that before I did this presentation. But it gets wiped after a little while, well, a small lifetime. So it does actually. If you didn't earn any money until that point, you would have not paid any of that back, and you would have just had it wiped. So for some people, it's going to be really great for them because if they didn't work, but that's not what you went to university for. You went there to work. So you're going to get this high salary, and you're going to pay a lot of money back. So you've got the different plans there. You've got plan 1, 2, 3, and 4 at the bottom of that page, and that sort of tells you what the expected rates will be. So that's just the actual interest rates on those things, and you can see they're quite high for a lot of them. So if you're plan 3, it's RPI, which is inflation plus 3%. If you're plan 2, which is, I believe, what I was on, then it should be RPI plus 3% for if I'm high income, and 3.2% if I'm low income. So yeah, it's quite a high rate. So if you're thinking interest rates, typically, I don't know, if you've got a mortgage, for example, they're going to be sort of around 4% probably, or just over that. So this is higher than that, which is quite a bit more. But in addition to just those interest rates, which is obviously on top of what you already owe, because that's just racking up as you can't pay it off, because you don't earn enough yet. Because for those first 10 years of your working life, you may not really earn enough to actually be making a dent in any of this. It's probably going to be just actually increasing. But you'll get to a point, hopefully, when you're earning £100,000 a year, and then you'll start to pay it off. So once you breach the 20, I think it's 27 roughly. So yeah, 26 to £27,000. Once you breach that level of income, then you start paying it. And at that point, you will pay, here we go, even with high interest rate, you still pay 9% of earnings above the threshold, which is, yeah, it's quite high, really. It's a lot of money that you're going to be paying off. So unless you're going to be earning loads and loads of money, you're not actually going to be paying this off, most likely. You're going to be maybe approaching the end of your working, at the end of that year, I think it's 30 years, that period, you may have paid it off by that very end of that point. But if you're earning about £50,000, £60,000, you're never going to pay that off. It's just not going to happen. So you're going to be paying that tax, in inverted commas, for your whole working life, probably. I don't want to put people off university, even that sounds so horrible, because university is great and you get a lot of life experience from it. So I know I benefit. I met my wife at university, and I know a lot of people do. So I think it's still worth it for obvious reasons. But we do have a lot of student debt, so which isn't great. However, I've got a colleague who sits next to me at work. He's 21, I believe, and he didn't go to university. He went straight into working for us, in fact. And he hasn't got student debt, and he's probably earning as much as I did when I came out of university. So that's quite irritating. I'm very happy for him that he's able to do that, because he's got an opportunity, and he didn't have to go to university to get it. So I suppose if your profession requires it, obviously go to university. If it doesn't, you've got a big decision to make, because it is a lot of money that you're going to be paying back for a long period of time. And unless you can afford it without the loan, that's when it's a big decision. Because some people are in a very, very fortunate position. They can afford, £15,000 a year to pay the maintenance and the student loan, or whatever it is to live at university. But unfortunately, not many of us can. So it's a big decision to make. But I can't make that up for you. I think that hopefully there's enough information there that makes some sense anyway. Um,
Thank you. I think like it's a lot of time people are going through the motions, i.e., pass through the funnel of education without really having to take stock or think about it. It's just kind of the done thing that you get your student loan, you go to uni. So it's
yeah,
really helpful to interrupt that thinking a little bit and actually look at the what it means to take out a student loan and how it will affect your life longer term.
yeah, for sure. I mean, I know that at least at the school I was at, I think probably 90% of people went to university. So I was maybe more than that even. So it was sort of the done thing. And so I didn't really ever consider not going to university. And then I suppose at the time though, when I actually went to university, they said, "Oh, we're not gonna have interest on this money." They didn't then stick to that, and now there is clearly quite a lot of interest on this money. So because they sold it off to a um, private company that now runs the student loans. So originally it was done by the government, now it's a private company, and they have no control over that now. So if they say they can wipe the debt, I don't know if they really can because they'd have to pay that company a lot of money to do that. And
Yeah.
also that company's making a lot of money out of that. So I don't know if they'd want to. So
Yeah.
um,
And then I
yeah,
guess
so I don't
for
know.
parents and families, if I may ask Tom, is it worth having a separate kind of savings for like potential uni funds? Is that or is that kind of will will it catch up with itself in terms of even that might not be enough because it changes so often?
That's a really good question. I suppose we could definitely help with trying to plan for that. I mean, and work out what you would require to be able to get to that point. If you're thinking, I've just had a child and I want them to go to university, start planning from the very beginning. I know I'm already doing that. I've got a junior ISA for my two children. I don't know what that's going to be used for. They may decide they want to use university. They use it for university. They may decide they want to use it for car, house, whatever they want to do. But I'm just putting £100 a month in. Fortunately, I'm in a position I can do that. Um, if you can, it's worth getting something because if you get by, we've already touched on this compound interest, 18 years worth of 7% plus growth. That's a lot of money if you just put £100 a month. I mean, that's £1,200 by the end of the year plus the 7% every year. And yeah, it's going to be a lot of money by the time you get to the end of that. And that very well could pay for their university. So if you're thinking I want my child to go through university, then maybe it's worth setting something up on a regular basis just to help ensure that happens. But again, we can figure out how much that would need to be for the specific scenario that people are in. And any advisor, I'm sure, could do that. So for us, we have a cash flow modeling tool that we use to basically predict what your likely outcome is by a certain point. Obviously, it's subject to market movements, but you can use sort of past data to get an idea of what that would look like. But yeah, it's definitely worth planning ahead and getting something in.
Thank you. Thank you.
No problem. So yeah, where are we at? So this little bit here, I'm just looking to go back to my agenda quickly, just check what I was supposed to talk about, if there's anything I've missed. So I'll learn things to get started. So there's a bit here that I also didn't put on my agenda. It
Surprising
seems.
yourself.
Uh, and this is a new initiative actually that we've generated. We've come up with this past 12 months. So a lot of the people that so well financially getting involved in it. That's actually the first reason we spoke to you guys was because of this initiative, and that is we give completely free advice now to anyone under 35 who is looking to buy a house. So if you're, and in fact, for things like licenses and junior ISAs, it's very rare that we'd charge you very much anyway. In fact, license I know would charge you zero before we even did this initiative, and I think for that reason we're thinking, why don't we just charge nothing for all of it? I suppose so. And then so that's where this initiative sort of was born, and my dad just sort of had this brainwave. We could be just we want to get people, we want to help people get houses. It's so hard to buy a house now that why not help people as much as you can, give them a free service to help them get there. So we have this thing called Thrive by 35, and we do it's like a forum every every quarter. So I think my dad, he started up the company. He does a little forum. He brings on people who he thinks are going to help. I think Wealth Financial are going to be on there as well this coming quarter, and it's just a discussion about different things that you can do to get yourself ready for that, for buying a house. So yeah, and using the specific products you've got, the different savings accounts, and talk about mortgage rates, all sorts of things that might help you get there. So these are some stats on it. So this is contrasting between sort of the years, the periods we've been in. So number of under 35s who own their own home in 2022, 2023 is 35%, and in the 2000s that was 59%. So it's gone, and I'm sure it's lower now than it was even then. So it's a drastic drop off, and it's because of the next 2 points really. The average house price in 2000 was 4 times the average income, and now it's 8 or 9 times the average income. So house prices are huge, although they haven't moved that much over the last couple of years. They've still been sort of astronomical compared to income, which hasn't actually gone up nearly as much as property prices have. And then you've got the national UK average deposit for a first-time buyer is 20%, approximately 50% of first-time buyers receive financing from parents. So most people do require investment or help from family members to get to that point. I know I fortunately have my grandparents helped me out. My mum and dad were able to help me out a little bit. And if you've started that savings journey or that investment journey from age 0, by the time they've got to the time they want to buy their house, if they didn't go to university, that fund is now used as a deposit on their house. So yeah, get that started. Yeah, 20%. I mean, I'm sure some mortgage advisor better equipped than I am to give you an idea as to what you're looking at in terms of rates and stuff. But yeah, 20% is a good starting point for sure. What was I looking at? What's included? Oh, this is what's included in Thrive by 35. So I've already kind of explained what we do, but yeah, we just want to help people get on the housing ladder. We know how hard it is. The stats back that up, and it's not being any easier year on year. So I don't know what they're going to do with, as in the government, what they're going to do with products regarding buying houses, because obviously we've got the LISA at the moment, which is really helpful, but there's rumours that they're going to not have that anymore and they're going to do something else. So we don't know what that's going to be yet. We'll see what that's going to be, and if it's better, hopefully. I doubt it, but we'll see. But yeah, hopefully, well, they said it's going to be simpler. Licenses are pretty simple, so I don't know how they're going to do that. So we'll see how that goes. Right, so yeah, I mean, hopefully that's quite self-explanatory. How you get started, I think, again, I didn't make these slides. My colleague Harry's done this, so I'm just sort of flicking through and hoping that I find something I can remember. So yeah, if you use the QR code there, you can go directly to our website if you want it, if you want to speak to someone. As I say, it's all free. We don't charge for anything on Thrive by 35. Even if you spoke to us about anything, we wouldn't charge you about it unless you became a client, to be completely honest. So yeah, that hopefully gives you an update on that. And any questions? I've got nothing else that I've been told I'm going to cover now. So
thank you so much. That was so helpful. Yeah, there are a few questions that have been sent in. If you don't mind if I fire them off, but pretty much leapfrogging off your presentation already.
go for it.
I guess the first thing people are wondering is there a minimum amount of disposable income, say, when either it's not worth looking at like alternative investments, or it's not possible? Like, is there a threshold that you can only start to contribute at a certain level?
As in a minimum where it's not worth it.
Yeah.
If you can spare, well, I think for a lot of providers that we speak to, they can be £100 a month could be the minimum that they would accept. A bank might be different though. So
Yeah.
we might be able to only get you for £100 a month minimum, but you could go to your local branch of X bank or Building Society and they may do it for £25 a month. I don't know what they're, maybe less. But it's, as long as you're doing something to generate future wealth, that's a good start. So I wouldn't say there's a minimum really, unless you find you do need that money, then obviously don't do it.
Yeah.
In the short term, I mean. But if you're thinking, I'm going to put some money away and it's going to help me in my future, just start doing it. Doesn't matter how small it is. It'll get to a point where maybe you can put more in. So just get started, I suppose.
Okay, fab, thank you. And then the other question was kind of around having these conversations or passing on these conversations and knowledge. So we've talked a little bit about junior ISAs, which seems like a really good starting point for families. But then I don't know if Matthew Douglas offer anything or what you can might recommend just from life experience about when is a good time to start talking to a young person about budgeting and planning and thinking about their financial future, and how do you, if there is a way to recommend having those conversations or like tools, tips and tricks that you might advise.
It's a good question. And I know that at least when I was a teacher, I remember doing work experience at a local school. That was a primary school. I was actually in high school and A-level teacher, but I did some work experience, and I think it was about year 3 and 4 where they were starting to have discussions about budgeting and lessons on it.
Mm.
Um, so what age is that? Must be about 8-ish, something like
Yeah,
that.
yeah.
So they have an understanding that 8-year-olds are pretty clever. They understand money to some degree, and I know that you can get, there were kids that live around my block that were doing car washing to make money. I mean, if you can have a conversation at all about it, then it's probably worth having that discussion at that point. But I mean, I know that at least from a personal experience, we have clients who would like their children to be able to um, start saving. So if they're, I don't know, they might be 16, 17, 18, as long as if they're under 18, then we'd have to speak to them with an adult. And we can actually have a meeting with them, with you,
Okay.
as well, and just discuss what your options are. We have done that. I've done it for students as well, where they've literally called me from their uni house, and we've just discussed what they can do to, once they've left university, how they can do more with their money. Um, yeah, as I say, we wouldn't, it wouldn't cost you anything to speak to us. So yeah, we're happy to have a chat. And as I say, but if it's under 18, we'll need to speak to the adult and the child, obviously. But yeah, I mean, that's a really hard question to answer, really,
Sorry.
to give you a full answer. But yeah, I think as long as they're, yeah, probably 8, 9, 10, I reckon that's fine to start having that discussion. That, when you start getting pocket money, if they start to
Yeah.
save money if they start getting money to save for their, I don't know, Pokemon cards or something, I don't know what it is that people buy these days. Probably not that now, is it? It wasn't when I was a kid. Um,
Yeah, exactly. And then there were a few questions about, thank you for that. Sorry, it is a
sorry.
difficult question, I appreciate. There are a few questions about what is actually involved in coming to like a financial advisor or yourselves. Like, how does it work? I think it's a little bit daunting for some people who might never have done that before. So what happens if someone picks up the phone or like drops you guys a message?
Yeah, so it's a pretty hopefully quite uh, easy process. I would hope. I mean, we're like, it's just normal people talking to normal people, like, I guess. But you come in, you have a meeting. We literally discuss your personal circumstance. So what your assets are, what your objectives are for those assets. Where do you want to be in 5 years? Where do you want to be in 10 years, etc. What are you planning for? When are you going to retire? Do you have any plans when you get to retirement? Any specific things you want to do? Are you going to buy a house in the next 5, 10 years? Who knows? We need to have that discussion first, and then if we think there's something we can actually help you with, that, like for example, if we could invest the money for you or give you a product that we can deliver personally, then we'll go away and write a report. Maybe it'll take a couple of weeks, and we'll have another meeting, and we'll see if you like the idea, and then that might be your first draft, and then of an idea, and then you might say, yeah, that I like the idea. Let's go ahead and let's do that. And then it's pretty straightforward from that point. You're just a client going with us going forward. But we might have that conversation. We go, actually, we can't help you directly, but we can point you the right way. We need to speak to Mr. Something rather about mortgages. You need to speak to this person about this specific protection product we think would help you. Um, or you need to speak to a solicitor. So a lot of people come to us wanting accountancy advice. That seems to be quite a common thing because they want tax advice or something. But if we can't do it, we know someone who can usually. So yeah, you might as well ask, I suppose. But yeah, I mean, the experience, as I say, hopefully people got the impression, at least today, that we're relatively normal people, really. So you can just yeah, just have a chat with us and about what you want, and we can hopefully try and help you get there.
Fantastic. Amazing. Thank you. I think that will settle a lot of nerves. Thank you so much,